In this video, taking a look at Bollinger Bands. Now, Bollinger Bands, if you remember your old math classes, there were the bell curve, the standard deviation, and 95% of action was within 2 standard deviations of the norm. So the idea is that price can get a little ahead of itself, a little lower overbought, oversold. That's essentially what you're using. The Bollinger Band indicator is a moving average in the middle. The 20 SMA, simple moving average, is the default for most platforms. So you'll have the moving average like you learned about in the last video. And then you'll have bands that form around it that show +2 standard deviations, -2 standard deviations. And keep in mind that this is the normal price, the trending average price. So let's click on indicators, click on Bollinger Bands, and you can see that we have a middle line here. This is your 20 SMA, you see 20, based upon the close, and then 2 standard deviations. So these lines, this is 2 standard deviations higher, 2 standard deviations lower. So when you look at a Bollinger Band, you should think of it as a couple indicators in one. So you have the moving average, you have the standard deviations, you also have the width of the standard deviations. So what I mean by that is in a more volatile market, they'll spread out because your average price swing and your average price for the day, in this case, is much higher. In a very kind of quiet, range-bound market that isn't doing much, you can see how thin it gets, and that shows you that the market just isn't very volatile at all. So you want to pay attention to that. Now, with all things technical analysis related, the first thing you want to notice is the trend. So when you have a slight lower or upper moving average, it's not a lot to do with the Bollinger Band. When you get a compression, then that tells you that you could get an explosive move rather soon. So let's go ahead and take a look at a couple runs here. We have broken higher. We've hit 2 standard deviations above the norm that is grinding higher with it. And you can see that we come back and we find support there. So the idea is that you can use the moving average as support. And you can see that if you just simply followed right along, you could have made quite a bit of money. But there does come this point here. So for example, this candlestick and this candlestick and this candlestick all catch my attention. And the reason is that they break out of the standard deviation band. And the one on the far left over here and this one are particularly interesting. And that tells me that perhaps it's time to exit a long position. This one tells me that we are starting to pull back. It's a shooting star. But when you close outside of 2 standard deviations, you are getting a bit stretched. So if you're long, this could be a reason to exit. Now, some people will short and try to aim for the other side. That's a bit riskier because you're not going with the overall trend. Another thing that you will sometimes see is some traders will actually look for a compression like this, and then once we explode to the upside, if you think about it, it makes sense that the first couple of candles do close outside of the standard deviation because we haven't been doing much lately. So what they'll do then is they'll just dynamically move their stop loss right along with the moving average to try to catch as much as the move as possible. Because clearly you had a breakout here, just based upon support and resistance, and then a close outside of it. So you could have gotten long here and gotten out here for a nice multi-week gain, because this is a daily chart that I'm looking at. The moving average starts to roll over. We close below. You could look to short next time we touch it. And you can see that it just kind of rinses and repeats just time and time again. An explosive move to the upside, formed a shooting star, but we broke above the shooting star, which is a very bullish sign. And you could see that that was probably a break even trade if you did the stop loss at the moving average thing, but you also had a shooting star close just outside of it, which, as I mentioned earlier, is a sign that perhaps we're getting ready to pull back. So you could have gotten in here, got out here, or here, just kind of depending on how you played that. Bollinger Bands, for myself, I found them to be extraordinarily useful for determining when a stock may move violently because of the compression. That's my favorite use for them. But there are a multitude of ways to play this. So just by all means, do stick with the trend though. This is a slightly bearish trend, so you could make a little bit of money selling. But then again, when you look at the longer term attitude of the market, you would have expected support there. So it's a tool. It's not, unfortunately, some people use Bollinger Bands as a complete trading system. And I think that's somewhat dangerous. You never really want to use just one thing. Price action, support, and resistance are the bedrock. And then you can add this on top of it. So for an example, let's go ahead and draw a horizontal line here at this previous resistance. So you would have known that somewhere around $32-ish there was resistance. And you would have also known that there was support here. So it makes sense that there's going to be a lot of buying pressure in this area. And that's exactly what we saw. So where's your signal? Well, your signal could be every time you break above this moving average. But quite frankly, I think the most interesting candlestick is the shooting star that formed here at a place where you would expect to see selling, and then it gets busted through the next day. If you don't like that, a return to the moving average, you would have had to wait a couple of weeks, but you got a nice opportunity there. At that point in time, you had multiple trades that would have worked out. Bollinger Bands are good, but you have to use them as a tool, not an entire system.